Is your money working as hard as you are? Because if it's not, you're leaving serious wealth on the table. And a big part of making your money work smarter, not harder, especially here in Canada, involves understanding something crucial: capital gains tax. It's a term that often makes eyes glaze over, but ignore it at your peril. It's the silent partner in your investment journey, influencing everything from your daily financial decisions to your long-term retirement dreams. For many Canadians, the idea of investing feels like navigating a dense forest. There are so many platforms, so many strategies, and then there's the government, always seemingly ready to take a slice. Today, we're going to demystify one of the biggest players in the Canadian investment landscape, Wealthsimple. We'll explore how this popular platform, with its user-friendly approach, interacts with one of the most significant taxes for investors, capital gains tax. You might be thinking, what even is capital gains tax? Simply put, it's the tax you pay on the profit you make when you sell an investment for more than you bought it for. Imagine you bought shares of a company for $100 and later sold them for $150. That $50 profit? That's your capital gain, and a portion of it will be taxable. It applies to stocks, mutual funds, ETFs, real estate, unless it's your principal residence, and even certain collectibles. This isn't just a rich person's problem. Anyone who invests outside of registered accounts like RRSPs or TFSAs will eventually encounter it. And misunderstanding it can lead to some unpleasant surprises come tax season. The reason this topic is so important is because it directly impacts your net returns. You can have a fantastic investment strategy, but if you're not accounting for the tax implications, your actual take-home profit could be significantly less than you anticipate. And for platforms like Wealthsimple, which have democratized investing for so many, understanding this interplay is vital. Wealthsimple prides itself on simplicity and accessibility, but even with their user-friendly interface, the underlying tax rules are still in effect. Before we dive into the nitty-gritty of Wealthsimple and capital gains, let's lay a solid foundation for capital gains tax itself. In Canada, only 50% of your capital gains are taxable. This means if you made a $100 capital gain, only $50 of that would be added to your income and taxed at your marginal tax rate. This 50% inclusion rate is a pretty sweet deal compared to how other forms of income are taxed, and it's designed to encourage investment. But it's crucial to remember that it is still taxed. The flip side of capital gains is capital losses. If you sell an investment for less than you bought it for, you incur a capital loss. And here's the good news: capital losses can be used to offset capital gains. If you have $1,000 in capital gains and $500 in capital losses in the same year, you only pay tax on the net capital gain of $500. Even better, if your capital losses exceed your capital gains in a given year, you can carry those losses back up to 3 years to offset past capital gains, or carry them forward indefinitely to offset future capital gains. This is a powerful tool for tax planning, and it's something sophisticated investors leverage to minimize their tax burden. Now, let's talk about Wealthsimple. Wealthsimple is a leading Canadian financial technology company offering a range of services, including robo-advising, self-directed investing, and even cryptocurrency trading. Their appeal lies in their ease of use, low fees, and commitment to making investing accessible to everyone. But how do these services interact with capital gains tax? When you invest with Wealthsimple, you're typically using one of two main account types: registered accounts or non-registered, taxable accounts. Registered accounts are your tax-sheltered havens. These include your Registered Retirement Savings Plan, RRSP, and your Tax-Free Savings Account, TFSA. In an RRSP, your contributions are tax-deductible, meaning they reduce your taxable income in the year you contribute. Your investments grow tax-deferred within the RRSP, meaning you don't pay tax on capital gains, dividends, or interest until you withdraw the money in retirement. This is a powerful way to compound your wealth over the long term. However, when you do withdraw, the entire amount is taxed as regular income. The TFSA, on the other hand, is arguably even more powerful for many Canadians. Contributions to a TFSA are not tax-deductible, but all investment income, including capital gains, dividends, and interest, is completely tax-free, both while it's in the account and when you withdraw it. This means any capital gains you generate within your Wealthsimple TFSA are untouchable by the CRA. It's truly tax-free growth. The key takeaway here is that if your investments are held within an RRSP or TFSA on Wealthsimple, you generally don't need to worry about capital gains tax on those specific investments right now. The tax implications are either deferred, RRSP, or eliminated entirely, TFSA. This is why maximizing your contributions to these accounts is often the first and best piece of advice for Canadian investors. Where capital gains tax comes into play with Wealthsimple is primarily in your non-registered accounts, also known as taxable accounts or personal investment accounts. These are accounts where you invest money that doesn't fit into your RRSP or TFSA contribution limits, or money you need more immediate access to. When you buy and sell investments in a Wealthsimple non-registered account, any capital gains you realize will be subject to capital gains tax. Wealthsimple tracks all your transactions, and at the end of the year, they'll provide you with a tax slip, specifically a T5008 slip, Statement of Securities Transactions, and potentially a T3, Statement of Trust Income Allocations and Designations, or T5, Statement of Investment Income, for other types of investment income like dividends. These slips report your dispositions, sales, and often the proceeds of disposition. However, and this is crucial, the T5008 slip does not always report your adjusted cost base, ACB. The ACB is the original cost of your investment, plus any commissions or fees, adjusted for things like stock splits, reinvested dividends, or return of capital. Calculating your ACB accurately is your responsibility, not Wealthsimple's, for tax purposes. Why is this important? Because your capital gain is calculated as your proceeds of disposition minus your ACB. If you don't track your ACB, you could end up overpaying tax or, worse, underpaying and facing penalties. Wealthsimple does provide excellent tools within their platform to help you track your transactions, including your average cost per share. For most simple buy and hold strategies, their internal tracking is usually sufficient for calculating your gains and losses. However, if you're engaging in more complex strategies, like frequent trading, dividend reinvestment plans, or dealing with corporate actions, you might want to consider external tracking tools or consult with a tax professional. Wealthsimple's aim is to simplify investing, but the underlying tax rules are still in effect, and the onus is on the individual investor to ensure their tax reporting is accurate. With that said, thanks for watching, and until next time.